Hey everybody, I hope you're all doing well. So pretty much in this session, over these next 30 slides, I'm going to be covering everything to do with supply and demand. Obviously I may have missed something. There's not going to be a trade recap, there's not going to be Wyckoff mentioned in here, but that's all in the Discord, that's all in the course, and I'll go over that in the end of the video. So let's jump into it, shall we? So when it comes to supply and demand, I'm not going to overcomplicate it like many people do, and let's be honest, it's just to make themselves look smarter or sound smarter than they actually are. Let's just admit that. Now, supply and demand is actually very commonly used in our day-to-day lives. So here's an example. So I stopped buying burgers when it became £7, and I started buying it again when it came down to £4. And it's the same thing. I can give you another example, guys. So supply and demand, you got to think, if I'm selling a TV on Facebook and I'm selling it for, let's say, £200, and someone wants to come and pick it up, but they only want to pay £100, right? Obviously that I'm not happy with that, and they're not happy with paying a full price. So what we'll do is if I'll counter offer them and be like 150, and the deal is done. And then what they will do, if they're happy with the deal, they'll say yes, and then obviously we agree and we meet in the middle. And that'll be your equilibrium, also known as a fair value. So as you can see on the bottom left of the screen, we have this supply and demand in economics. You can Google it and it'll show you this, and it's the exact same way the market works, right? So the law of supply is that when there's a higher price of something, the more sellers will sell it, right? Smart money is not about buying huge units at an all-time high. And why would they do that when they can buy it a week later at a much better price? So when you see markets trading at all-time highs, yes, it seems like a good thing, doesn't it not? But in reality, it's not, right? This is why when the S&P 500 and the NAS 100 the other week was at an all-time high, it's took a dip now. And I mentioned it taking a dip because it's like buy the rumor, sell the news. And it's completely 100% true. Because when it's spreading around, obviously you want to get in trades. But when it starts to hit the news and there's a lot more people buying at all-time highs and whatever, right? Why would we want to pay that expensive price if we can just wait a week later, like, the smart money do? Or, the big players, when I refer to smart money, I just mean the big players, right? But why would they want to do that? Why would they want to buy at an all-time high when they can just wait a week later when the price drops and buy it for much cheaper, right? And obviously a lot of people, from the general public, they're going to be buying all-time highs, and obviously once you do that, it's the same with Bitcoin as well. A lot of people, they started buying around the 50k region, and then obviously it took a huge dip back to, I believe it was 25k or 30k, correct me if I'm wrong, but you get the idea, right? There's obviously also many things we can use and to determine supply and demand targets, but actually what we'll do is we'll just jump into the video. Now, first things first, the big players do not utilize the seconds to the minute time frames. Just remember that, right? They only use the higher time frames. They simply await a good deal in price and they will execute. Okay, just remember that. So supply and demand, when supply exceeds demand, it goes down, and when demand exceeds supply, it goes up. Okay, so if there are more buyers in the market, then demand's in control. If there's more sellers in the market, then the supply is in control. Okay, so just remember that, and like I said, you can look up supply and demand in economics and it'll come up with those that sort of chart there, and I think it's in the Discord as well. I think I created one myself as well, so you can always check that. And the little box in the middle where it says P and the Q, that is where you meet, and that is the equilibrium, what's known as fair value. So the supply would be me if I was selling the TV on Facebook for £200, and say for example you wanted to buy my TV, you'd be the demand at the bottom, then obviously we'd have to meet in the middle if we're not happy with the prices. But yeah, you get the idea. Okay, and that burger is really making me hungry, I must admit that. So before moving on, to me, supply and demand zones and order blocks are a similar thing. However, order blocks is just more of a pivot created zone, so one candle rather than multiple candles, so a range created. Order blocks is used by banks to split their big orders into smaller chunks so that they get their orders filled at better prices, just without disturbing the market equilibrium, right? It's essentially just a market behavior that reveals a pile-up of orders by large entities. Now, here's an example. Bank 1, so let's say Goldman Sachs, JP Morgan, whatever bank you want to choose, they want to pump 105 million into the markets, but rather than disturbing the price too much, they'll split it into chunks. So for an example, they'll put 25 million to create a down move, they'll put 50 million to pump price back to the zone, and then 30 million to pump price down again. So it's obviously outweighing it, right? That is our entry. Okay, so when you see a huge rally, left imbalances, there's a supply and demand zone there, that is where you want to enter from, right? They are extremely careful about their risk management, and if anything, it's actually very, very interesting because the amount of control that they have, and it's really interesting. It's like props to them. But obviously they, no one knows how they trade. It's more quantitative style, so algorithms, and you get the idea. But yeah, just remember this for later on in the video. If you have chosen the right zone, price will truly commit to mitigating it, and you will usually see a bigger move. And it shouldn't be spending too long in the zone. We should see price tap into it and go, right? We shouldn't be sat in the zone for too long. Okay, so first things first, make sure you understand order flow. Now, order flow is pretty much a synonym for trend, market structure. So for example, is price in a bullish market, is price in a bearish market, and that's pretty much the order flow. Now, I identify my order flow on a higher time frame because obviously that's what the institutions and the banks use. They obviously trade on a higher time frames. They don't use a minutes charts. Don't get me wrong, you can look at your point of interest on small time frames if you are trading a 1 minute time frame, which would essentially be scalping. But for me, always identify them on a higher time frame, look for that lower time frame confirmation entry. Obviously, when it comes to trading something like the Asian session to learn session manipulation, which I'll jump into, I think I'll jump into it later, I'm not too sure. But then obviously that's a little bit differently, but it's all in the course, guys. Make sure you go ahead and watch it. Now, when it comes to order flow, as you can see, I'll just read it out to you if you can't read it on the screen. But these marked zones, the pink one with the blue squiggly lines in the middle, they are complex pullbacks. And essentially, it's just noise that confuse a lot of people. And in the CP, and the CP is a complex pullback, that is a build-up of liquidity awaiting to be collected. Okay, so sort of like a compression into a demand zone in this example. So the key takeaway here is that we must focus on the outer perspective, so the higher time frame, and the complex pullbacks are just noise. So I recommend, before I jump onto that, we can actually trade complex pullbacks, don't get me wrong, but we just got to be aware of the high time frame point of interest, because we know if the overall market is moving bullish and we're selling on a lower time frame, the market can just reverse at any time it wants to do so, right? We have no control over the market. So if you walk counter trend trading, don't try and hope for the big return trades. That those trades will come preferably with the higher time frame, order flow. So if you're trading high time frame order flow and you're counter trend trading it on a lower time frame, that's absolutely fine, because you could be swinging a trade and obviously hedging it on a lower time frame, and which is what I'll jump into in a different video over in the course. But you get the idea. You can trade it, but just be aware that the market can reverse any time, because the overall order flow is against the current trend that you're trading on a lower time frame. Okay, so when starting out trading this way, I only recommend to trade based off a high time frame point of interest at the swing points. So if you are new to this, all I would recommend for you to do is hop on the charts, identify what the market is doing. So is it making higher highs, higher lows, or is it making lower lows and lower highs? And then once you do that, actually draw them out and look for your supply and demand zones. Obviously we'll jump into that in a minute and how to draw them. But make sure you just go with the overall higher time frame. And that's what I recommend personally when it comes to starting out, because it will avoid a lot of confusion, and trust me, you'll thank me later. Then as you get a bit more advanced, you can start trading a complex pullback, because what I find a lot of people do is they'll jump straight into this and they'll instantly be on a 1 minute time frame, stuck on a 1 minute time frame, and they completely ignore the higher time frame, and then they're losing trades and they're asking themselves why. And it's because they shouldn't be focused on the first, personally, right? So trade a complex pullback is a whole different story, but first just understand trading based off higher time frame points of interest. And when I say point of interest, all I'm referring to is simply, so it just means supply and demand zones. So yeah, only focus on trading when you are new to this, the higher time frame point of interest with the overall order flow, blah blah. Now, another thing to note is that when you are struggling to figure out what the order flow is, just look and think. At each major swing point, is the supply zones being respected and the demand zones being violated? Or is demand being respected and the supply being violated? Okay. Now, just for your information, as you can see on the screen, the first breaker structure is an intent, and an intent is pretty much an anticipation. So if we're previously a bearish market making lower lows, lower highs, and price breaks a lower high, then obviously we're going to have a bullish intent. But if price starts to make another higher high from prior to breaking up breaker structure, so taking out the lower high, then creating another higher high, then that's confirmed the order flow. Okay, so as you can see, moving on how to draw them is actually very, very simple. Now you have your supply level here, or you can call it supply zone, supply level. It's completely up to you. But we know it's a supply. And the reason for that being is simply because it's the last bullish candle before the down move that broken structure. Right? There's a bit of structure to the left that was broken. I'll explain what breaker structure is and stuff like that later on down the line. And it will start to make sense. But when you are looking at your supply and demand zones, make sure you try and find the last bullish candle before the down move that broke in the market structure. Then all that we're doing is we're waiting for price to pull back, and there's different entry techniques. You can enter from the open, midpoint, you can enter based off of risk entry, confirmation entry, and I'll go into all of that later on. But just understand that for a supply zone, it's like a resistance, and a demand is a support, right? But a supply, just find the last bullish candle, so the up candle before the down move that broken market structure. Okay, and I'll go over imbalances as well. For a demand level, it's exactly the same but the opposite way around. All that you're doing is you're finding the last bearish candle before the up move that broken market structure. Okay, so rules and notes. For a demand zone, you want to be drawing from a bearish candle, and if you can't see it, then you need to go back by candle and locate the nearest bearish candle prior to the up move. So another way to do this is if price is trading, bullish, all that you want to be doing is trying to find your demand zones. If we're bullish on the H4, the daily time frame, find the demand zones at the swing points, so the higher highs, the higher lows, and then find the supply zones at the lower lows, lower highs on the higher time frame, right? And just wait for price to pull back into them and look for a confirmation entry, in which we'll jump into later on. And for a supply zone, you want to be drawn from a bullish candle, and the same rule applies, but followed by a down move. Now, I'm just quickly kind of find something which I'll pull up in a minute and explain a couple of things about it. I'll give you a quick reality check soon. So recent zones, we're moving on. So recent zones are more important than older zones. The older it gets, the less significant it becomes. So time frames do matter. It does vary from time frame. If it's a higher time frame, then obviously it depends what order flow or what supply demand zone it is. But if we have already mitigated a supply demand zone, or we are like 5 pips off from touching the open of it, that's invalid, and we move on to the next one, right? So make sure you understand your ranges, and this is something we'll touch up on in the Discord, on the course and stuff like that. All right, pay attention to higher time frames. Remember that institutional traders aren't even paying attention to the seconds or even the minutes charts, right? Remember, huge moves are from institutional influence, and they make the big moves happen, not us. Moving on to this one. Now this is where it starts get a bit more advanced now, so make sure you do listen up. So when you have a trading range, and how you identify them is pretty much exactly the same how you draw up a fib tool, right? So if you know how to draw up a fib tool, then well done. All that you're drawing up is, for example, if you have a daily lower high and lower low, you want to draw it up from that lower low to the lower high, and that will be your trading range, right? If you have a 4-hourly bullish range, you have a higher high, a higher low, higher high, higher low, you'll draw up from the higher low to the higher high, right? And then that would be your trading range. Now you have two options. This is the Fibonacci tool. You can set it up. It's a 1%. It's a 1.5 and 0. Okay. Now we have it red and blue. We don't have the levels on there. We have it red and blue. So when you have a trading range, we want to ideally be selling at premium extreme points and buying at the discounted extreme points. The equilibrium, so in the middle, the line in the middle, as you can see, also known as the fair value, is when we relate back to supply and demand in economics. Like at the start of the video, it is tradable, as it may be a low time frame trade within a higher time frame range, but it is not recommended, right? So for the higher probability setups, only trade at the extreme points. So when you're looking at supply and demand zones, don't diddle in the middle, as they say, alright? But seriously, patience is very, very key. So if you're trading from high time frame point of interest and price is taking a while to pull back, then that's fine. Just, suck it up, I guess, right? But don't be diddling in the middle. I mean, you can do. It's like when we go back to the order flow, it's like the complex pullbacks. It's similar to that, right? So if you have a high high and a high low, and you want to buy, make sure you're drawing up, and you want to buy. You'd be buying in the blue zone, right? So if you can find a valid supply and demand zone, or order block, whatever you want to call it, which is just a supply and demand zone, if you want to try and find a valid supply and demand zone inside that range, then make sure you draw up the Fibonacci tool, right? Because we want to be buying in the blue zone and selling in the red zone when we are looking for sells. Okay. Now the reason why we want to sell and buy in those certain zones is because you got to think, right? If price is in a discounted zone, we want to buy. It's like when you go to your local Tesco's or Walmart if you're in America, or whatever, Target, right? Aldi, Morrison's, you get the idea. But when you go into any shop and you see a discount or a clearance sale, we're instantly attracted to that, right? And it's the exact same rule applies. And I think the more you think of the trading markets in terms of more modern day life, I feel like the easier it becomes and the easier it becomes to read. Okay, so when you see things at a discounted price in the market, so when you drop the Fibonacci tool and you want to buy in the blue zone, it's exactly the same thing as buying something in the shops at a discounted price. And then the premium is where it's expensive. So obviously when you're selling something, you're selling a car, you're selling something on Facebook, you're selling a TV, your Xbox, whatever you're selling, you always want to try and get more bang for your buck, as they say, right? You always want to try and sell it at the most expensive price possible. So why wouldn't we want to do that in the markets as well, right? You get the idea. Now, moving on to supply and demand, entry and stop loss example. I'll go on to take profits in a minute, and I'll go on to entry and stop loss a bit more advanced as well. But as you can see, as an example of supply execution and an example of demand execution. So as you can see, right, we have identified a supply zone on the top right picture. We have our stops just above the zone, so we have to give it room and breathe. Make sure you have a couple pips just above the zone because it could wick above. But entry is on the open, and I'll go into entries in a minute. But your entry is on the open and you can have it on the midpoint, which you'll jump onto, but which is the red highlighted, which is the middle point of the zone. But entries on the open in this case, and targets will vary. I'll explain why in the next few slides. But just look at where I put my stops pretty much in this slide. So stop loss is always above or below the zone. Okay, don't be greedy. So when it comes to take profits, you're probably wondering, where would you put them? Now I do things a little bit differently here. I do not have predetermined take profits like most people do. Sometimes I might. It just depends what I'm doing. If I'm a little bit busy and I want to just take the day off, or I've got stuff to do and I'm in a trade, then yeah, I'll have a predetermined take profit at the next available supply and demand zone. But I do things a little bit differently. Okay, but like I said, if you want to have your predetermined take profits, right, always target the next available supply or demand zone, always. But for me, most of the time I would just simply listen to what the market is telling me to do so. Oh, excuse me. Okay then, Luke, you're probably wondering, what do I mean? So what I mean is, if you look on the picture on the right, alright, the green line represents my trailing stop losses, and all trailing stop loss means is just where you're sort of trading your stop loss. So if you didn't know, what you can do is you can trail your stop loss into profit. Excuse me. And say for example we entered a trade based off a supply zone, right, and then price breaks structure, so it took out a higher low, and we now flip to a bearish market. What we can do is we'll leave our stops where it is, but when price pulls back and it forms a lower high and then it goes on to form a lower low, that's when we can move our stops to break even, because we know if price is truly bearish then it should be following the structural order flow. But the minute it breaks back above, then that's when we close, right? And there's ways you can do this in terms of allowing it to be managing your trade on a 1 minute time frame, and then manage it on a 5 minute, and then a 15 minute, then 1 hour, and eventually it turns into a swing trade. But that's something we'll talk about a bit more advanced later on in the course, right? But as you can see, every time price breaks a lower low, you're just trading your stop. But you need 2 breaker structures in order to move your stops to break even. Okay, so just quickly pause the video and look at that video. Look at that picture, right? But as you can see, price broken structure, you trail your stop, blah blah, and then price broken above, so it closed above, and I'll go on to breaker structures in a minute, but it closed above, and that is where you would close the trade. Okay. Stop losses. Now, stop losses will always be above / below the zone. So make sure that you draw up the correct zones. So for an example of this, if you draw up a demand zone, so the last bearish candle before the up move, but the candle next to it has a wick lower than the bearish candle, then have your stops below the wick. Right, and the moral of the story is to not be greedy by focusing too much on the risk to reward ratio, because remember, the small wins do add up. Trust me. But please refer to my stop loss video. It's a 2-minute long video. It's in the Discord, in the entry section, and you can go ahead and watch that and explain much more things in depth. And it's only 2 minutes, so make sure you watch that video. Now, another thing as well, just because you see people online and social media, it may even see me, and you see people hit these 1 to 10 trades, 1 to 100 trades, 1 to 50 trades, they are achievable, because you got to think, right, if we go back to this slide here, what if price just kept continuing and continuing and continuing, and it didn't close back above, right? That trade would turn into a huge trade, and that's why I manage my trades like that, okay? Because sometimes, yes, we may only take 2% from the market, may only take 3%, but sometimes it may even, go on to be a 50% to even 100% trade, right? The only other 100% trade I've got is on Bitcoin, which was absolutely crazy. I literally doubled my money, and it was in such a short time, and it was way more than 100%, but I want to keep it. I want to just tell you guys it's over 100%. I'm not going to tell you the exact figures, because I don't want you to start not believe me. But as you can see, that Bitcoin rally that we had not long ago, I got in at the most precise entries ever, and it was shared in the Telegram as well back when we had the Telegram, and it was actually pretty crazy, which was nice to see actually. But yeah, we was up like 90% on one trade and then 80% on the other trade, and you get the idea. There was like 3 or 4 entries as well, and then we obviously closed it later on. But that was crazy. That was absolutely crazy. But enough of going on about that. But yeah, just because you see people on social media hit these big trades, it's probably going to make you feel like shit. Let's be honest, right? It is. And I 100% understand that, alright? Because it's the same with me when I used to load up, you load up Instagram, you're following someone, and then you see them hit a 100 to R trade on the same day that you didn't take a trade. You start to feel like crap, right? And most of the time, I can almost guarantee you they are chatting, right? It's not even a real trade that they're taking, they're just waffling at that point, alright? But for me, I'll keep it real with you guys. Like the other day, for example, in the Discord, I put in a trade recap upon yen, and I admitted that I did not take the trade. I admitted that it was 2 pips off my stop loss, my entry, sorry, because it was off 2 pips on my sell limit, right? And I will be honest with you guys, and not many people will, because let's be honest, you've got to admit yourself, a lot of people will turn around and be like, oh, I entered this trade, guys, well done, whoever caught it, and they brag about it on social media. But for me, I admitted, I put my hands up and said, look, I missed a trade by 2 pips, and it is what it is. Now moving on to entries, we get a bit more advanced in here. So you got V1 and V2, and I'll go into them in a minute. So in V1, we're going to be going over risk versus confirmation. Now you want to take a trade from a supply and demand zone, right? You have 2 options. You take a risk entry or a confirmation entry. Again, this is completely subjective and up to you, but a risk entry is just identifying the supply and demand zone and setting a limit order on it. Simple as that. And a limit order is a buy limit or sell limit, okay? A confirmation entry is a little bit more complex, but it is still utilizing a lower time frame to, find your entries by looking at a structure break. Okay, so in terms of pros and cons, the con entry has high probability and higher win rate. Cons, you may not always get a pullback on a low time frame. You break structure on a low time frame, but you may not pull back to a supply demand zone. Right, risk entry, pros and cons. Pro is actually getting into the trade, so if price is truly going to commit to a supply and demand zone, you're actually going to get into the trade rather than missing it, right? Cons, you may just get it may just violate supply demand zone, and obviously it's a lower win rate. Okay, so you're going to experience more losses. But as you can see on the right side of the screen where I put the arrow, so you've got a higher time frame point of interest. So let's say the 4 hourly point of interest. So you've identified a 4-hour supply demand zone. Once price taps into it, all that you are looking for is a lower time frame breaker structure. I will go over time frames in a minute, but for me, I always look at the 5-minute for my breaker structures. But it's completely subjective and up to you, and I'll jump onto a guide that you can use shortly. But as you can see, if you look for the lower time frame structure breaks to the downside, in this case because it's off a supply zone, then obviously we want to trade this exact same process. We have a supply zone, breaker structure, pull back, and that'd be our entry on a lower time frame. Right, it's just confirming the order flow. You can enter off it in 10 or the overall confirmed order flow. Okay, entries V2, so you have open, midpoint, or close. Now again, over these next couple of slides, okay, I meant to put this in the V1. I was supposed to put this one in, but it was this past couple of slides was dedicated to entries anyway. But in this slide we'll be discussing should you take an entry on the open of the zone, the middle point, or the close of the zone. Now it's completely up to you. This is very subjective and there's many pros and cons, but the main ones when it comes to taking a trade off the open, there's obviously a higher chance of getting into the trade. Cons, however, there's a lower chance, there's a lower risk to reward. Midpoint and close, bigger risk to reward, but there's a higher chance of you missing the trade. Okay, for me, I would always enter off the open because I don't want to enter off the midpoint. Right, obviously it depends on the gap and how big the supply and demand zone is. But when you're taking like a confirmation entry and you're looking at a 5-minute point of interest, that is enough. You know, even if it's just a 1 to 5, that is enough. I get it. You know, you want to hit a 1 to 50 trades, it will happen. But don't focus on that because you're focusing on the outcome. You know, my personal recommendation, advice to you is to focus on the, process of accumulating a great trade idea. And then moving on to breaker structures, you probably hear me mention this quite a few times throughout the video. So let's just cover it up. So a breaker structure is just essentially price breaking a price. So it's super simple, right? But you gotta think to yourself, what do you class as a break off structure? There's 3 types. For me, I use type number 3, right? Many people, especially in the Discord, shout out to some of the members, they use type 1, sorry, but I don't recommend type 2. Alright, it's completely trial and error though, it's completely up to you, it doesn't really matter. Because I find that, if you're using breaker structure number 2, there's a difference between a liquidity grab and the breaker structure, and you can get quite confused. So I'll go over them now. So there's 3 types, right? Number 1 is body, breaking the body. So what you do is you draw your trend line, or your horizontal line, and you have it from the open or the close, whatever, of the candle, and you map it out. And then obviously, if price breaks above the price, you'd wait for the candle closure to close above it. If it wicks above it, then that's not break structure, right? However, you map it out on break structure number 2 using the wick, and you class your wicks as a breaker structure. Now again, that could be a valid if it's up to you, but I find that a lot of people get confused. If they use type number 2, they get confused on a liquidity grab and a breaker structure. So again, it's completely subjective, trial and error, see which one works for you and which one doesn't. Okay, breaker structure number 3, my personal favorite and the personal one I use, is body breaking the wick. So pretty much when it comes to body breaking the wick, all that you're looking for is a candle closure above the wick. So you map it out using the wick and you look for the candle closure above or below. Okay guys, again, a quick reminder, any questions at any point, make sure you send me a message on Discord. I don't know how far we are through this course, but we're doing good on time, I think. So supply and demand zone examples. So in these examples, the pullbacks are to the open, but obviously remember it can also pull back to the midpoint or even a close, especially when it comes to range created. I find it likes to pull back to the equilibrium. So the next time you're looking at trade setups, look for these common setups, right? And when I say setups, I mean supply and demand zones. Reminder, these all look like they're range created, so multiple candles, but it can also just be one candle, also known as an order block. 4 that we see very commonly is RBR, DBD, and DBR and RBD. Now all that is rally base rally, drop base drop, and drop base rally and rally base drop. Okay, and we see them very commonly. So those are just how you identify your supply and demand zone. So if you're looking at a high time frame, you see price creating high, low highs, lower lows, and whatever. You can usually see a pullback to it, and that'll be our entry on a pullback. Right, we don't want to be trading the breakout. We want to be trading the pullback. Because if you're trading a breakout, that's just more liquidity, and obviously the breakout traders most likely going to be stopped out, right? And this leads us on to liquidity. So liquidity is one that must be understood. All that it is money. So obviously we are trading smart money, right? Yes, we're still retail traders, I get that, but we do not use the retail logic. But ask yourself, why are the statistics so high when it comes to traders who are failing and losing money in the markets, right? It's like 90% to 95%. I'm not sure how the statistics, obviously with the Zeus Capital community, the statistics are going to be lower. But you must understand, if the statistics are so high, ask yourself, how are they trading, right? If you go on YouTube and type in Forex course, it's going to come up the same shit. Support, resistance, trend line. I do recommend to learn this. It is hard to unlearn it and relearn this new stuff, but I feel like you would understand this stuff a lot better if you previously learned that. That's an argument on its own, right? But ask yourself, right? Why would we want to trade that way? That the majority of the traders are trading, we literally want to be doing the opposite to what they're doing, if anything, right? As we know, the market is made for us to have a bias towards one thing, but in reality, the complete opposite will happen. So what we have to do is, we have to think in retail logic. So breakout traders, break and retest traders, support and resistance zone to zone traders, trendline traders, where are they entering? Where is the stop losses most likely to be? And this is how you get this edge. If you were previously trading this way, you will have the edge over the people who have come straight into this rather than learning the old stuff, right? Also, the way I see with liquidity is that it is the fuel for the markets. It's like if we need a car to run, we need to get to work in the morning, right? We need the car to just drive in general. We need to fill up with fuel. We need to oil it. We need to check it. We need to do all that stuff. And it's the same. Like I said, the trading is exactly the same as the day-to-day life. And the more you make it more into the day-to-day life, the more profitable you'll be. Because it's like, you have to fuel up the car to drive, right? Otherwise, without fuel, it's not going to go anywhere. You have to give it checks. You have to get it serviced, MOT'd. And that is pretty much just like us back testing and testing our system to make sure it works. All right? It's exactly the same as a modern day-to-day life. Now, we need to eat as well. We need to eat and drink in order to stay alive, right? You get the general idea, and that's pretty much it really. And liquidity is just the money in the market. So if you do previously trade this way, and you previously, like for me, I was previously a break and retest more kind of guy with fundamental data, and that was profitable. That's why I don't bash this retail logic. And what makes me laugh is I find that a lot of people who come and switch to trade supply and demand, is they bash retail logic and say that's not profitable. But when you go back to their old posts, they used to trade that way. So it's so ironic. It's like, okay, mate, there's a couple guys on Instagram as well, and they class themselves as pro traders, whatever, and I just cringe so hard at it, right? I'm not bashing anyone here, I'm not going to mention names, but you probably see for yourself. And they say, we've been trading for like 8 years now, we have like 50 years combined between us all, 10 years, whatever, right? You get the idea. And they were previously trading support resistant zone to zone trading. Even I even coached some of the people out there as well. And they previously traded break and retest, fundamental data, whatever, and breakouts. And now all of a sudden they switch to this, right? And they're bashing it. They're saying it was not profitable. People who trade it's bullshit. That's what they're saying, right? Excuse my French, but I feel like when you swear, you sort of get the message across a bit better, right? I'm not going to be an idiot about it and swear, but you get the idea. I feel like when I do swear, I feel like it gets the message across a bit better. It sort of like wakes you up. But you get the idea, right? But they used to bash this, and it's like, well, you said you've been trading for 8 years, mate. So if it's not profitable, what were you doing for those 8 years of trading? It's like, come on, mate, get a grip, But that's what it is. Liquidity examples. So When it comes to liquidity, it's essentially just money in the market. As we know, it's the fuel for the market. It's just like for a car, and it's fuel. Otherwise, it isn't going anywhere. Anyways, moving on. The first example on the left side is equal highs and equal lows. So when it comes to trading these, we're often taught to sell at double tops and buy at double bottoms. Yeah, we may see a short-lived move. Don't get me wrong. Like I said, I'm not bashing it. It does work. If it works for you, then great. You don't need to change it. Don't fix what's not broken, right? But as we know, the markets like to target liquidity in the long run. So these tops and bottoms will be taken. We also have the trendline liquidity, which pretty much just, as we know, buy and sell on the third touch, right? Two touches is what confirms the trend line. Wait for the breakouts of the trend line. Again, this just creates a bunch of liquidity waiting to be taken. Next up is a range, otherwise known as typical support and resistance. The price is ranging. Obviously, we're taught to buy from support, sell from resistance. It's very simple logic, but it's essentially just gathering a bunch of liquidity waiting to be taken, and we're taught to buy from from support and sell from resistance, right? And like I said, I'm not saying it doesn't work, because obviously it does. It does. If it works for you, then great. As traders can just load up an MT4 app and be like, yeah, I'm going to buy here. I'm going to sell here. I'm going to put a 5 lot size on. Pretty simple, right? And it's just a click of a button. However, this is definitely not the case for the big players or the smart money. So institutional traders, hedge funds, they can't just load up the MT4 app and be like, yeah, I'm buying here. I'm selling here. This lot size going here. Okay, I'm calculating my risk, blah, blah, blah. Okay? It's not so simple for them to do that. As we know, in order for there to be a buyer, there needs to be a seller. In order for there to be a seller, there needs to be a buyer. And the modern life is very much the same for trading. Supply and demand, liquidity, etc., etc. But as we know, if we wanted to pop into our local Tesco's and Walmart and they are not selling anything, then how are we going to buy anything? You get the general idea, right? And the markets are very much alike our day-to-day lives, as I mentioned, very much. So if we apply the same concepts to the markets, we know that there is if we know that there's so many people buying from support and selling from resistance, of course we're going to see manipulation. Alright, once we do see these liquidity grabs, manipulation, whatever you want to call it, they're adding fuel to the markets to move. So again, if there's so many people buying in a dominantly bullish market and there's no sellers, then the price is obviously only going to go up. But there needs to be a seller in order for there to be a buyer. There needs to be. So obviously that's why, which leads us on to imbalances. Okay, now imbalances is pretty much just where there is a gap between price, where the wicks do not meet from the first on the third candle. It just essentially means there is, it's imbalanced and it will need rebalancing. So why does this happen? What does it mean? Why does this happen? Right? And it's simply because both buyers and sellers did not get a fair chance to the liquidity. Right? Imbalances is something that makes the supply and demand zone valid along with a breaker structure. And I'll probably cover that up in the end of the video. I feel like I've probably missed something. But if I have any questions, make sure slide in my DMs and let me know. But imbalances is where there's a gap in prices. You can see on the images below. It's very simple. Don't overcomplicate it. And the wicks don't have to mean like that in order to make it a balanced price. The wicks can go up or down. They can go as big as they want. But when there's a gap between the first and the third candle in terms of the wicks, then obviously that's the imbalance. And it's just, for example, if it's bearish, like that example, then that means it's a very dominant market and there's only sellers in control, and the market doesn't like that. So price will need to rebalance itself and continue in the desired direction. Now momentum. Now this is a great confluence to add. I don't trade based off momentum, but it's a very good confluence to employ. I find it very helpful when it comes to looking at trading opportunities. So momentum, the way I look at it is, I want to see who's in control, the bulls or the bears. And there's many ways you can see this. It's actually very, fairly simple. You can just look at the candles and you can easily tell who's in control. But an easy way to do it is by using the date range tool. You can use the measure tool on the left side of the trading view tools as well. But if you look for the date range tool, you can measure them up. And before I jump onto that, you can. Why is this beneficial? You may be wondering. Well, if we're looking at taking a sell position, we want the bears to be in control, right? So if we're looking for a sell, we want the bears to be the more bearish people than there is bullish people, right? But if there's more bullish bars than there is bearish approaching our sell area, then is it worth taking the trade? Well, no, because the momentum is not there, right? So we need to make sure we measure it from the equal highs and lows. So for example, when you see a supply zone sell off, then a pullback to it, that's how you measure it, right? We're just looking at how fast it took price to reach the same point in price, both bullish and bearish. So focus on the bars, not the time, because we have 28 bars, well, in this case on the right side of the screen, we have 28 bars to the downside and 41 bars to the upside, right? So in this example, what is the momentum? It's bearish. And the reason for that is because it took less time to reach the same point in price when it was previously a bullish market. But it only took 28 bars to reach the same point in price from where the bulls took off. So if we were looking to, for example, if we were looking to sell from there, would it really be worth it? I mean, if you're looking to buy from there, right? Because there's so much bearish momentum. Obviously, an example, I drew price to the upside and blah, blah, but you get the idea, right? Just look to see who's in control. If there's less bars, then great. Market timing, kill zones, and sessions. Now, over the next couple of slides, I'm going to be moving on to these sort of things. Now, market timing and with kill zones is very, very important, right? Because, excuse me, guys. Because certain things happen during certain times. Bear with me, guys. I'm just going to call up my missus. 2 seconds. Right. Now, between 12 a.m. and 5 a.m. in the morning, UK time, GMT, that is my Asia session. I know obviously if you Google it, it'll say it doesn't close at 8 o'clock, blah, blah. But over time and experience, you start to pick up on these things and it will make sense later on. But between those hours on the screen, those are my learning session, New York session. So it took 11, 1 till 5. Bear with me. Bear with me, guys. I do apologize. It's just she's in the shops, and I don't know what I want for tea tonight. I think I fancy a steak. To be honest, guys, what are you saying? Right, I'll probably edit that out anyway. So for me, I obviously don't trade all the hours. However, I do like to usually catch the first couple of hours of the sessions. So I'm more of a learner trader, as I look for the manipulation to occur from the previous Asian session. So in short, all that it is if price breaks above the Asia high as we head into the London session, then I will look for a lower time frame structure break to the downside and look to sell. Crazy, right? Because we usually taught if price breaks above or below the Asian session, that will set the direction for the rest of that day. And ain't that right? You got to admit that, right? If you Google it, it'll tell you. So I'm pretty much doing the opposite to everyone else, because remember, the majority of the people who fail in trading, right? The statistics are so high. Why would we want to be doing what the majority of people are doing, right? So if we just continue to, range in London and we don't break above a higher low in the Asian session, or we get a minor break, I would simply look for the breakout in the New York, right? And in the New York session. And in the New York session, we either see one or two things. We see a continuation or a reversal. And majority of the time, I will admit it is a reversal, but obviously it can sometimes be a continuation. So we can act like it will be a continuation always, until we see that change of structure to the downside. But remember, don't be scared of losses, right? For example, if you buy because you expect in a continuation of the bullish move we've seen in London, then you get stopped down, we flip bearish, and why not re-enter after a valid signal and sell? And not many people do this because of fear, and I'll give you a reality check in a minute that will sort of give you a little boot up the bum, right? And it'll make sense. So my kill zone is between 5 to 11, and sometimes I will stop earlier. It just depends on how price is. If it's boring, I will come back and try again in a New York session. And remember, the patience this whole time is key. We don't have to trade every day. Then if I do come back from stopping earlier, I will trade from 12:30 till 14:30, right? But usually, the average time going back over my history, my in and out trades is between 6 till around 10ish. So for those, few hours, it's usually when I'm trading the most during the day. Now, I don't mind being on the charts. It doesn't matter what time you trade. Just try and know it to see what works best for you, right? I understand if you work, you have kids, have a job, you do other things, you have a hobby, then it may be a little harder and maybe a little difficult. But just remember that everyone has the same 24 hours in a day. Remember that. Even Elon Musk, Jeff Bezos, Mark Zuckerberg, Charlie Munger, Warren Buffett, The Rock, Dwayne Johnson, Vin Diesel, everyone. So make it work and don't look for excuses. Okay. Time frames. Ideally, you only need 3 maximum time frames when accumulating a trade idea. The daily, H1, 15-minute and 5-minute for your entries, or 5-minute for your entries. But for me, I also like to utilize the H4 and 1M. H4 being my refinement time frame for the daily, and the 1M being my refinement for the 15 and below. And we'll discuss refinement on the next slide. So even though people recommend using multi-time frame analysis, it's very hard to not get lost, and you'll just end up confusing yourself by over-analyzing the markets. So just keep it simple, alright? I only use those extra time frames because I have that experience in the markets, and that's my edge in the markets compared to other people, right? And the more experience you get, the more things and diverse you will be. But here's a rule of thumb, and you can use it as a guide. So I mentioned earlier on in the video that we'll go over time frames later on, and here we are. So if you have a monthly, weekly, or daily point of interest, right? So a monthly, I don't have a monthly point of interest, but if you do and you use a monthly time frame, then good for you. But you should use a daily and below for your entries. So when it comes to entries, all I mean is breaker structures in the opposite direction. All right. If we're trading based off weekly POIs, use H4 and below. Daily POIs, use H1 and below. For day trading, that's for swing trading, sorry. But for day trading now, use H4 POIs and use the 30-minute and below for entry. H1 POI, use 15-minute and below for entry. And then for scalp trading, if you want to scalp in the markets, look at the 15-minute point of interest and use the 5-minute and below for your entries. Okay. Now moving on to refinement, I must say this before we continue. The more you refine, the less probable the trade is, right? What is refinement? So if you have a daily supply demand zone and it's way too big to take a trade from, if you want to take a risk entry, for example, you can simply drop down the time frames to refine it and look for a supply and demand zone inside the daily supply demand zone. Okay. Now, again, this is more based off if you're trading risk entries, because, you know, if you are looking for confirmation entry around the supply demand zone, then it really shouldn't matter how big the zone is. But you can obviously refine it as a guide, I guess. But all that we look at when price is at or near a supply demand zone, then that's when you change the time frames to the lower one and look for those, you know, structure breaks to the opposite direction, right? But refinement is more, like I said, for risk entries. But yeah, now the reason why I say it's less probable, is because the more you refine, you may be thinking, well, isn't it getting more accurate? Well, technically yes, but you must remember that the big players who move the market do not use the smaller time frames. So for that reason, they will much prefer to take a trade from a daily zone rather than a 30-second zone, right? So be pragmatic about it. You can refine imbalances, the same concept applies as the zones. But as you can see on the right side, we have a daily demand zone. We have a daily order block, whatever you want to call it. However, on a 4-hour time frame, so how many 4s are in 24? There's 4. Correct me if I'm wrong. I'm pretty crap at maths. But as you can see, on the 4-hour time frame, you have a last down candle before a potential up move, and that would be your refinement, right? And there's many ways you can do this. You could just use a wick trick of the daily demand. You can see that in the Discord and stuff like that. Now, trading instruments. Now, I don't mean which guitar you're going to use, which guitar you're going to trade, you know, whatever. No, but seriously, I only really recommend to trade in one pair, right? Really, I do have a few pairs that I do use, and the only pair that I actively trade in the lower time frame is pound yen. I do trade higher time frames and sometimes lower for pound dollar and euro dollar, but I do have a few pairs that I do forecast for you guys in the Discord group, and also if you do have a suggested pair for me to forecast, I will do it. But my watch list is mainly pound yen, pound dollar, and euro dollar. Alright, pound yen is more, like I said, for my lower time frame trading and just generally trading a London breakout. Euro dollar is good for New York. I will admit that. And the pound dollar, not something I traded too much, but obviously it's a mix between the pound and the euro, with euro dollar and pound yen. So I do like to trade that sometimes, and sometimes it'll help with confluences and, you know, currency correlations. Also others as well. I do trade West Texas oil. I obviously have the dollar index. I don't trade the DXY. It's just for obviously looking at the confluence and stuff like that for the dollar. I also like to trade gold now and again. And this is something I forecast in the Discord. But again, if you do have any other forecasts you want me to put in there, I do also forecast Aussie dollar, US dollar, and a couple of other pairs as well that I have forgotten about. And another pair that I've been trading lately and I want to start trading a bit more is the Dow Jones, NAS 100 and other things like that, US 30, the VIX volatility index and stuff like that. I want to start trading into those markets, and that's something I will be looking at. I probably will do a course on that one day as well. Notes and reminders. So you do not want to become a buyer after a huge rally, and you do not want to become a seller after a huge drop. Right? Consistent analysis and consistent execution equals consistent results. Right? We do not have an impact on the market. Only the big players do. So just follow them and ride the wave. Big players only use higher time frames. Anxiety in everyday life usually stems from feelings of uncertainty, so make sure you're in the correct mindset. Always journal, backtest, and stay prepared. Try to remove as many variables as possible when taking a trade, as it will reduce anxiety / feelings in general, and have a rule-based system. Remember that the art market always is F all. Do not listen to other traders' opinion. Always do your own due diligence. Even if you follow my analysis and let's say I want to buy GJ and you want to sell GJ, then sell GJ. Always trust yourself. Most of the time, especially in retail logic, we are made to have a bias towards one idea, but in reality the complete opposite will happen. More trades do not equal more money. Less is more. So try to avoid social media. Trust me on this one. Or only follow the people you know, for example your friends, family, my page, and a couple of other trading pages that you like. But social media is really depressing, honestly it is. For higher probability, always be with a higher time frame order flow and use the peaks as your supply and demand zones. You need to be patient, and lastly, just take the damn trade. Bite the bullet. And I'll explain this. I said, yeah, okay, right. Listen up to this one, guys. So, remember these words. Fear is your worst enemy. Not your broker, not the markets either, but fear. And a lot of people will relate to this one. So we enter a trade, you get taken out of the trade, and then it heads in the desired direction that you initially wanted it to move in. This is such a common occurrence that it boggles the mind onto why the trader does not re-enter the trade after a valid entry signal. Most traders are usually at the right side of the market on the order flow, but we're just often a little bit too early. The big trades will come, like I say quite often, consistent analysis and consistent execution equals consistent results. Whew, took a breath out of me that one, right? But who cares about losing 1%, 1%, and then you get a big 1 to 5, 1 to 10, 1 to 20, right? That's the power of risk reward, and as we know, losses are inevitable. But like I said before, fear is your worst enemy, as we know. So when you next take a loss, just ask yourself, was I too early, or am I generally on the wrong side of the market? Or was there something wrong with my entry, or did I just get the direction wrong, right? It's okay to be wrong. If you admit that you're wrong in the markets, then salute to you. But just remember to be reactive and not predictive. Stop trying to predict the next move. Just react to what the market is doing and get in, get paid, and get out. If you're so fixated on trying to guess the next move, it will create psychological issues or barriers. Sometimes we need to just buy in order to discover that it was actually a sell position, and sometimes we need to sell in order to discover that it was actually a buy position. So learn from it. But in simple terms, we need to pay up in order to discover the truth. And this is 100% true, because you got to think, guys, right? If you enter a buy position on pound yen and you get taken out by a pip and then it moves in your direction, breaks structure, enters into a new range, allows you to create a new point of interest, right? Why not take that trade? Re-enter the trade. I get it, we just lost, and it's a very common occurrence that it boggles the mind that we shouldn't re-enter. But if you can just pull the trigger and bite the bullet, like I say, and just enter the trade, then you will. That's going to be great, because fear is your worst enemy. Because like I said, you lose a trade, you don't want to trade up here again. You just come back the next day or whatever. But just re-enter after valid trade entry. Why not? Just react to the market. And again, just don't try and predict what's going to happen. Obviously, we can do our forecast, we can prepare for the next week, but if I forecast that pound yen is going to be bullish for a certain week, then it turns out to be bearish, I'm not going to sit there and try and buy all week. I'm going to sit there and react to the market. I'm going to sell, right? And there's little footprints in the markets that will help us with the direction of the market. So, for example, the Tuesday's candle over, the footprint of the Tuesday candle, the weekly candle. There's a video on the Discord if you want to watch that. But these little things that will help give us the overall directional bias. But yeah, you get the idea. Alright, so my favorite trading setup, I thought I'd share this one, and we see this literally very commonly. So LG is liquidity grab and SB is structure break. So I'll give you guys a minute to just go ahead and take a look at this. Excuse me, this is my longest video ever, and I hate doing long videos. I really do, because I find a lot of people will get tired. But this is an all-in-one video. You can come back at it, pause it at any time, and yeah. Okay, so I'll explain a bit more in depth now. So pretty much, we have a demand zone and we have an imbalance. The reason why we have a demand zone and an imbalance is because we have a breaker structure. Alright, so this is a swing point as well. So if price is moving up, it's creating higher highs, high lows, and for example, this is a higher low. So we want to be trading off the high lows. So a demand zone from this example is an order block, so the single candle, so the last bullish candle before the up move, that broken structure. And if that last down candle before the up move has an imbalance in price, then that's confirming that that's a valid supply demand zone, well, demand zone in this case, right? And in the middle is equal highs, so for example, a triple bottom and a double top, and as you can see, we had a liquidity grab to the upside, right, creating another double top, and that's what it would usually do. And then it came back down, took out the triple bottom, also known as equal lows, tapped into a demand, and that would be our open. And again, we'll just target the next available supply. If that gets violated, we'll just go on to manage the trade like we do, as we mentioned earlier. Now, fractal markets, I must mention this one quickly. Look at the image closely on the right side, right? In short, just do not get caught up on a low time frame bearish trend if the higher time frame is bullish and vice versa, right? So as you can see, the blue line is the daily time frame, the H4 time frame is the red lines, the 15-minute time frame is the green lines. So as you can see, even though the daily time frame has gone up, down, up, right? Within that 15-minute time frame, price has gone up, down, 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 up, down. So just remember, just do not try to get lost on the lower time frames. Make sure you zoom out if you are in doubt. That's number one tip. But yeah, that's pretty much why fractal, price is fractal markets is pretty much what you see on a lower time frame. You ain't going to see on a higher time frame essentially. But it will also, if you look at the image, it'll make sense, and that's a fractal market for you, right? So common terminologies, you can go ahead and screenshot the video, pause the video. I won't go ahead and read over these, but some of these are for Wyckoff as well. So if you want to learn Wyckoff, it's in the Discord, it's in the course. Make sure you go ahead and learn all that as well. And risk management as well, very key. Obviously, I've got this on here. Now, here's the only way to survive these markets. Remember that, right? If you want to survive in the Forex market, especially long term, and then even in any market, the rule number one is to always protect your capital, right? I recommend to never exceed at least 3%, right? The way we trade, 1% is enough, right? To be honest, I never recommend to exceed 2%, but 1% is enough, right? For me, I use 0.5%, but the moral of the story is that just do not keep changing it, right? Focus on the long term, and going back to the reality check, the one we just had as well, you'll understand why, right? Because if you're risking 0.5%, then you take, like, for example, 4 losses, that's only going to equate to 2%, right? So you're down 2%, and what happens if you enter another trade, 0.5%, and it turns out to be a 1 to 10 trade, you're taking 5% away. But even though you took 5 trades with a 0.5% risk, and you only won 1, it's still profitable, and that's the power of the risk reward, okay? But remember, just don't exceed however much, and just try and keep it the same percentage risk all times. Because what I find a lot of people do is they'll risk 1% here, 2% here, 5% here, back down to 2% here, 1% here. But if you just keep it, and it will make sense over the long term, right? But I recommend to really come up with your own risk management profile and just your overall money management in general. So your drawdown, overall drawdown, daily drawdown, risk percentage, risk to reward ratio, lot size, etc. How you manage to trade, everything, and have it all written down on a piece of paper or printed out on a computer. I do obviously have some guides and PDF files, PNG images that you can go ahead and look at in the course, and they're great to look at. Also, you can calculate your lot size easily on a calculator, or you can head over to our Discord and check the risk section, and there will be a link to our website that you can easily calculate your lot sizes. But here's how to on a calculator. Right, so number one, you want to find out how much you want to risk in money. So you want to work out how much you want to risk. For example, that is 1% of, if you have $1,000 account and you want to risk 1% of that, as we know, is $10. Right, so you put in $10 divided by your stop loss in pips. So if you have a 3 pip stop loss, so 10 divided by 3, what does that equal? And then you have to obviously, click equals what, and then you divide that by 10, and then that will equal your lot size. Right, so for example, $10 divided by 20 pips divided by 10 is a 0.05 lot size, and so on and so forth. Okay, so now we've got to the end of the course, and you're probably thinking, now what? Now at this point you should have gained some value, if not a lot of value, hopefully, but you can always rewatch this as many times as you want. But if there's any questions, make sure you do message me on Discord. But what I would recommend to do now is to go through all the content in the course on our website and go over the Discord videos. Right, there is extra information in there and tips that will take your trading to the next level. Things like Wyckoff, market footprints, entry techniques, frequently asked questions, case studies, trade recaps, psychology. Right, there's loads of things in there that you will gain a lot of value from, but this one is pretty much covering everything. But other than that, I'm going to wrap the video here, guys. So I really appreciate if you're still watching this far, then salute to you. I know you're going to be so successful in life, but thank you for watching, guys, and I'll catch you guys in the Discord.